Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of UnitedHealth Group Incorporated, ticker symbol UNH. We're looking at UnitedHealth as a subscriber request today. Currently, UnitedHealth is trading for $538.17 per share. They've done it very well over the past year. Their stock price is up nearly 18%. That's in very sharp contrast to the overall market. Over the past 5 years, UnitedHealth has compounded at a rate of approximately 21% annually. Over 10 years, they're compounding at a rate of about 26% annually. Going back prior to the global financial crisis, over the past 18 years, this rate drops off to about 15% compounded annually. While that is below what they've done over the last 10 years, that's still very good over this time, and that would beat the S&P 500. In addition to this, they also pay out about a 1% dividend yield. So if that yield had been about the same this entire time, then the overall return to shareholders would have been about 16% compounded annually from UnitedHealth. So very good results over the past 18 years. Their stock price has gone up by over 11 times during this period. UnitedHealth is trading about $20 below their 52-week high. They're up over $100 from their 52-week low. UnitedHealth is one of the largest businesses in the world. They have a $503 billion market cap. For some background about the business, UnitedHealth Group is one of the largest private health insurers, providing medical benefits to 50 million members globally, including 5 million members outside of the United States at the end of 2021. As a leader in employer-sponsored, self-directed, and government-backed insurance plans, UnitedHealth has obtained massive scale in managed care. Along with its insurance assets, UnitedHealth's continued investments in its Optum franchises have created a healthcare services colossus that spans everything from medical and pharmaceutical benefits to providing outpatient care and analytics to both affiliated and third-party customers. UnitedHealth Group Incorporated was incorporated in 1977 and is based in Minnetonka, Minnesota. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of UnitedHealth based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public, so it's going to continue to improve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. So this is the case for UnitedHealth, and this is important for 2 reasons. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured by return on capital. And the second is that the average publicly listed business earns about a 7% return on capital. So by asking for 14% average returns on capital or greater, we can potentially build in some margin of safety for ourselves by looking at businesses that are about twice as good as average businesses. UnitedHealth's returns on capital are about as steady as they come. Over the last 5 years, they've averaged about 18.5% returns on capital, and currently over their last 12 months, this is bumped up a little bit to about 20.5% returns on capital. So this is above the 14% benchmark we're looking for, and this is a check to start things off on metric number 1. Metric number 2, here we're taking a high-level overview of the cash coming into their business. We want their revenues, earnings, and free cash flows to have grown over the past 5 years. This metric is all or nothing in nature. Either all 3 of these are going to be up for a check, or if even one of them is down, this entire metric will be an X. So over this time, including their last 12 months of numbers, UnitedHealth has grown their revenues by approximately 50%. Their earnings are up 50% as well, and their free cash flows have actually tripled over this time. So very, very strong growth for UnitedHealth over the last 5 years up until currently. This is another strong check on metric number 2. Metric number 3, here we're taking the perspective of an individual shareholder in the business. We're looking for earnings per share growth over the last 5 years. So UnitedHealth's earnings have grown by about 50% over this time. Additionally, UnitedHealth has repurchased about 3% of their shares outstanding. So when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. So when a business buys back their stock and decreases the number of shares that they have outstanding, they're increasing your ownership percentage in the business, which is ultimately going to increase your percentage of the business's profits going forward. So coupling the strong earnings growth with their marginal buybacks, this has led to earnings per share growth of more than 50% over the last 5 years alone. This is another strong check on metric number 3. Metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. Currently, UnitedHealth is producing about $34 per share of free cash flows. That's a result of their free cash flows just about tripling over this period. And coupling that again with their small amount of buybacks, this is very strong free cash flow per share growth over this time. So this is yet another check on metric number 4. We are 4 for 4 to start things off, meaning that we are perfect through our first 4 metrics. Additionally, there are a couple of things we want to be aware of in this metric as well. One is that over extended periods of time, meaning 10 plus years or more, so here we're only looking at 5 years, we want to see that a business's earnings and free cash flows are roughly about the same. It's actually somewhat beneficial that their free cash flows are slightly above their earnings in these years. And from an accounting perspective, this would potentially be a very high-level sign of quality accounting in their business. Again, if you had any concerns about the accounting for this company, you would want to dig in and look more at those metrics in more depth. But it's good that we're not seeing wild disparities between these two. The other thing to be aware of is that their above average returns on capital, coupled with this strong per share growth in their metrics, really can be potentially indicative of UnitedHealthcare being a wonderful business, in that these two metrics combine to really allow for very strong intrinsic value per share growth over extended periods of time. So those are 2 additional potentially positive signs to be aware of for UnitedHealthcare. Next up for metric number 5, here we're evaluating how the company is utilizing leverage. So we want their net debt, which is long and short-term liabilities minus cash and short-term investments, to be below the amount of free cash flow that UnitedHealthcare has produced over the past 5 years. UnitedHealthcare ended last year with about $29 billion in net debt. They've significantly reduced this amount. Right now, they just have under $10 billion in net debt. And over the last 5 years, UnitedHealthcare has produced about $82 billion in free cash flow. So in any of these 5 years, with just 1 year's worth of free cash flows, they would have been able to pay off all of this net debt. And over their last 12 months, they produced $31 billion of free cash flow alone. So it's likely that some of those free cash flows alone went to reducing this net debt position. So that big increase of why it spikes so dramatically from these other years is because of a $9 billion change in net operating assets. So if you're interested in learning more about that, you can dig into the company's filings to learn more. Either way, this is yet another check on metric number 5. We're still perfect 5 for 5 through our first 5 metrics. Our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield above 5%. If this is the case, this will give us a slight risk premium to the rate of the 10-year Treasury yield and give us another potential reason to be interested in UnitedHealthcare. We're using their total enterprise value here because it's going to give us a picture of the economic reality of the business that's going to be more similar to as if UnitedHealthcare were a private company by taking into account both their market cap and their net debt position. So currently, UnitedHealthcare has a $521 billion total enterprise value, again, one of the largest businesses in the world here. And we learned that over the past 5 years, UnitedHealthcare has produced $82 billion in free cash flow, which means that in an average year, they're producing about $16.3 billion of free cash flow. So when we divide their $16.3 billion of average free cash flow by their $521 billion total enterprise value, that gives us an average free cash flow to enterprise value yield of approximately 3.1%. So on an average basis, that is below the yield of both the 10-year Treasury and that 5% mark we're looking for. And so unfortunately, this is going to be our only X here coming in all the way at the end on metric number 6. Worth being aware of as well is that over the last 12 months, again, UnitedHealthcare has produced $31.3 billion in free cash flow. $9 billion of that was attributable to a change in their net operating assets. So when we divide their last 12 months of free cash flows by their total enterprise value, that gives us a current free cash flow to enterprise value yield of about 5.9%. And if we were to exclude that $9 billion change in their net operating assets and then get an adjusted current free cash flow to enterprise value yield, that would give us an adjusted free cash flow to enterprise value yield of approximately 4.2%. So on that adjusted basis, which is probably what's going to be most similar to economic reality here for the business, it would look like UnitedHealthcare is just about right in line with the yield of the 10-year Treasury currently. So this means that even though this is an X on metric number 6, the business could potentially be worth looking at nonetheless. Do keep in mind that this is just one data point out of 6. We had 5 checks through our other metrics, so overall you want to take this analysis in holistically. Then here we're looking at UnitedHealthcare's dividend profile. So it's important that if a company's abilities to pay out their dividends is a consideration in your investment research, that you stop and you look at the fundamentals of a company and understand whether their dividend is well supported by that business's earnings or their free cash flows, depending on the type of business. For UnitedHealthcare, we want their dividends to be covered by their free cash flows. In all 5 of these years, UnitedHealthcare has increased their dividends per share payouts. and they've been able to very easily support this with their cash flows. They've never paid more than 30% of their cash flows out as dividends. This is a sign that UnitedHealthcare's dividend payouts are very conservative relative to the cash flows the business is bringing in, and that it's pretty likely for this business going forward that these dividend payouts would be healthy and sustainable. Right now, UnitedHealthcare has consecutively increased their dividend payouts for each of the past 14 years. So if they're able to keep up these cash flows and are able to marginally increase their dividends going forward, then they are potentially on the way to becoming a future dividend aristocrat contender, which means that if they would hit that status, they're a member of the S&P 500 and they would have consecutively increased their dividend payouts for each of the past 25 years. So UnitedHealthcare looks like it's potentially in strong consideration to become a future dividend aristocrat, potentially about 11 years out from now. Then finally, here we're using a discounted cash flow model to come to a potential fair value for UnitedHealthcare. So starting with an average of their free cash flows, which is going to account for this extraordinary year that they had over their last 12 months due to this one-off change in net operating assets, and then projecting their average free cash flows out over the next 20 years, based off of historical assumptions for how UnitedHealthcare has been able to grow their free cash flows since 1990, so over the last 32 years. If they're able to match this growth over this time, then projecting a growth stage out over the next 10 years, where UnitedHealthcare grows their free cash flows at a rate just under 17%, then we project a terminal stage for the business out over the next 10 years out after that, so projecting 20 years into the future in total, where their growth rate goes down all the way to only 6% annually. Then we're not adding in their tangible book value because that is going to be skewed based off of how the accounting is done for the company's buybacks. Then if we're seeking a 10% rate of return potentially out over the next 20 years for UnitedHealthcare, a fair value for the business would be approximately $565 per share. So there does look like there's a little bit of margin of safety in that fair value calculation versus what their stock price is at today. Please keep in mind that this model is using these historical assumptions, which you need to do your own homework on to determine whether or not these are both going to be accurate and potentially applicable as a baseline projected estimate for UnitedHealthcare going forward. There are a number of reasons why this wouldn't be the case, so it's up to you to do your own homework here. Secondly, this rate of return would be including their dividend payouts. Thirdly, a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to depend on its inputs. So through deeper research into the business, you'll be able to determine for yourself what would potentially be more reasonable and realistic inputs for this model going forward. And then finally, and most importantly, this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered financial and legal professionals. So in summary, UnitedHealthcare checks the box on 5 out of 6 of our metrics. They were only slightly off when it came to their average free cash flows compared to their enterprise value. That was giving us a yield below that of the 10-year Treasury. When we adjusted their last 12 months of free cash flows to take out their $9 billion change in net operating assets, then that looks like their current free cash flow to enterprise value yield is approximately what the 10-year Treasury is yielding right now. So that's potentially something interesting to look at for the business. Then based off of the business's abilities to produce free cash flows, it looks like they're using a very reasonable amount of leverage in their business. Over the last 5 years, they've experienced very strong revenues, earnings, and free cash flow growth, and they bought back about 3% of their shares outstanding. So they've experienced strong per share metric growth as well. Additionally, UnitedHealthcare's return on capital over this time is about as steady as they come. They have average returns on capital in the high teens, just at about 18.5%. And this, coupled with their minimal use of leverage and their strong per share metric growth, is potentially very indicative of UnitedHealthcare being a wonderful business, that they've been able to steadily compound intrinsic value per share growth over this time. And based off of their current numbers, it looks like they'd potentially be able to continue this going forward into the future. Then looking at their dividend profile, UnitedHealthcare is paying out a very conservative amount of their cash flows as dividends to shareholders, and it potentially could be the case that UnitedHealthcare is a future dividend aristocrat contender. They would need 11 more years of consecutively raising their dividends to be able to hit that. Then finally, performing a discounted cash flow analysis of the business, using historical assumptions based off of their abilities to grow their free cash flows since 1990, which you need to do your own homework on to determine whether those are going to be potentially applicable to serve as a baseline projected estimate for UnitedHealthcare going forward. Then it looks like from today's valuations, there's a reasonable margin of safety in the business to get about a 10% rate of return going forward on the business over the next 20 years. This would be about 6% below where they've been at historically over the past 18 years. but it looks like the business is about fairly valued for a 10% rate of return. It's also worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered financial and legal professionals. So instead, this analysis serves as a beginning and holistic understanding of UnitedHealth Group to help you determine whether it's worth your time and energy to dig in and learn more about the business going forward. So one resource that will definitely help you stay up to speed with what's going on in the market and will help you learn more about UnitedHealthcare is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I am a part of their affiliate program. So most of you probably know Seeking Alpha as a source of community written articles on different stocks, but over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's very own algorithm. You can also see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years worth of financial data on any stock to help you with your analysis. And you can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's just 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. As a value investor, you're ultimately trying to conduct this deeper research as if you're going to own 100% of a business, and you can truly understand the essence of the business going forward and understand what's important and what's not important for the company. So through this deeper research, you'll ultimately learn more about both the qualitative and the quantitative aspects of the business, and you'll be able to determine for yourself what a potentially appropriate intrinsic value for UnitedHealthcare Group is. So with that said, that's it for today's fundamental stock analysis of UnitedHealthcare Group Incorporated, ticker symbol UNH. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about UnitedHealthcare with me, and have a great day.